This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky. We're near the end of September 2022, and the market is in a real tankathon. So I had a question from a Patreon subscriber named Scott. By the way, Scott and everyone else, thank you for supporting me on Patreon and via YouTube Premium. But Scott had a question for my monthly Q&A session that I do. And I thought it was worth posting for everyone to see because I think this is a really helpful and interesting question to be thinking about at this time. Scott says, Nathan, considering the economic turmoil that appears to be heading our way, will you be altering your investment strategies? First of all, I'll just say that yes, I agree. It does appear that we are heading for some economic turmoil. However, I'm not actually selling any of my stocks, nor do I plan to, basically no matter what happens in the future. And I'm going to give you 7 reasons why. Thanks to everyone for supporting my channel. If you're interested in signing up, I'll put a link in the description below. The first reason is that my time horizon is not 12 months. Way too many people get way too caught up in what the next 12 months or 24 months or 36 months of the market look like or what they think they're going to look like. So yes, the next 12 months of economic data probably isn't going to be all that good. Maybe it will, maybe it won't, but probably not, at least based on the headlines. However, I'm not investing for the next 12 months. I'm investing for when I'm like 55 or 60, which happens to be in about 25 or 30 years. So the question for me is not what's going to happen to stocks over the next 12 months. The question for me is what's going to happen to stocks over the next 20 years. These are the stock market returns from 1872 to 2018 over different rolling time periods. So 1 year right here. Back in 1872 through 2017, we have, you see a lot of red, right? So basically every 3 out of 10 years are negative. And sometimes they're very negative. So back here in the late 1910s, the S&P actually dropped for the year 35%. Happened again in the early 30s and again here in the mid 70s, and then 2008 obviously was another point when the market dropped. I think it was about 37%. So over a 1 year period, the worst stocks did was negative 37%. The best single year was right here, and stocks actually went up 53.2%. But if we look over the next 5 years, you see a lot less red, and the red is a lot less bad when you do see it. So the worst 5-year period was negative 11.7. And keep in mind, this is annualized, so that is actually a very bad result, even worse than the 1 year. However, once you get to 10 years, things get quite a bit better. The worst rolling 10-year period was an annualized negative 4.1, but the vast majority are green. You only see little pockets of red here in the basically Great Depression time period, and then again in the 70s. But if you go out even further, 20 years, there's actually never been a single period where stocks have lost money on an annualized inflation-adjusted basis. So this is actually, even considering inflation, the worst return was an annualized 0.5% per year for 20 years. The nominal return then would be adding whatever inflation was over that time period. And so right now I'm looking at probably at least 20 years, if not maybe closer to 30. So what I care more about is this, not this. Reason number 6, less investment costs. If you buy a stock for, say, $100 and then ride it up and it starts to go down and you sell it, maybe you sell it at, I don't know, whatever it is, $120. You end up having to pay taxes, if it's in a taxable account, on that $20 gain. And every time you do that, paying taxes, you're basically reducing the amount of money you have compounding by whatever the tax rate you have. Not only that, but anytime you buy and sell a stock, there's a small percentage of that that gets lost in the bid-ask spread. And there's a pretty good amount of research suggesting that for every 100% market turnover, portfolio turnover, your investment results drop by about 1% per year. So that means if you're buying and selling everything in your portfolio every single year, you're giving up about 1% per year in investment costs. And then there are certain cases where people still charge a commission, like it used to be $10 per trade at TD Ameritrade. Now I think they're all free, but you can guarantee that they're making their money somewhere along the way. They're making a profit. You just may not see it. So the bottom line is, more you trade, the more your investment costs will go up. Reason number 5, it takes a lot less time. If you're going to trade the market based on headlines, that means you got to be reading all the headlines. You got to be doing all this analysis all the time, paying attention to charts or whatever you're looking at to try, most likely unsuccessfully, time the market. Takes a lot of time that, quite frankly, I'm just not interested in putting in. I think there are far better things for me to be looking at and focusing my time on, and looking at the market, reading the news is not one of them. Reason number 4, it takes a lot less energy. And what I mean here by energy is mostly a psychological or emotional energy. Imagine if you think the news is bad, right? So you sell all your stocks, and then maybe over the next couple weeks, things start to get a little better. Maybe there was just a full-on panic and everyone had already sold, and so now you're getting a little bit of a relief rally, we'll say. So 5% or whatever the market goes up. Now, in the back of your mind, you're thinking, well, shoot, I just sold. Should I get back in? The market's now 5% higher, right? There's a psychological component to not wanting to kind of lock in that missed 5%. So you're kind of constantly, even if it's not right on the front of your mind, there's a kind of a low level anxiety maybe, or energy level that's being lost, just trying to constantly, day after day, think about the market moves, whether you made a good decision, what should you do next, should you buy back in, should you sell more, right? Should you sell now, should you sell in a week? There's all these things that you've got to be thinking of, and that's a lot of energy that's going towards that decision. And I think and I find that it just isn't worth it, right? I think you and I, for sure, want to spend our energy looking at things that are more important to investing, and most importantly, just more important to life, right? Like if I'm trying to make this decision on whether to buy or sell stocks tomorrow, and I'm playing with my kids or whatever, like I'm going to have a little bit of a distraction in the back of my mind. I'm not able to focus fully on what I'm doing with them because I'm trying to make this decision. So I don't think it's going to matter all that much anyways. So I'm just saying, forget it. It's not worth the energy for what potential gain I might have. And number 3, the base rate. And what I mean by base rate is that the market tends to go up between 70 and 75% of the time. So if I'm going to be out of stocks for, say, a year, the odds that I'm going to be correct on that decision are 30%. Now, could that come true? Yes, I think it definitely could. However, the odds are certainly not in my favor. In fact, if we just look at the S&P 500, it turns out the market drops by 10%, basically one time every year. It drops by 20% or more once every 6 years, right? So this is where we're at right now. But this study by the Capital Group found that after a 15% drop in the market, the recovery turned out to be an average of 54%. So yes, right now the market looks like this, but at some point I'm thinking it's going to look like this, right? That's what history would suggest. So the only way this is going to really benefit me is if I get out here and get back in here. And that seems like it would be easy, but trust me, it is not. Right about the point you think the market's going to continually go lower, everyone else thinks the exact same thing, right? Everyone else has the same access to all the data and the news that you do. So chances are this panic moment is probably pretty close to the bottom. So if we just play the odds, chances are this bull market run is going to be a lot bigger and happen more frequently than these. So rather than try to mess around with timing all these little market declines, I'm just letting it ride because the odds are simply on my side. Number 2, I'm just not that smart. Go study the legendary investors. What you'll find amongst all of them is that they all are basically buy and hold value investors, meaning they're looking for high quality businesses that they can get at a decent, fair or below fair price. And then they just hold on to those for a very long period of time. I do not know of a single famous investor who has gotten that way by being a market timer. If anyone knows of a famous investor that was a market timer, let me know in the comment section below. I do not know of a single one. So if those investors, the Warren Buffetts of the world, have basically said, we can't do it, what makes you think that I can do it or you can do it, right? So if none of them, way smarter than us, way more information than us, can't do it, neither can we. Maybe you'll get lucky, but in my mind, why try? And the number one reason why I am not selling my stocks right now is that there's a limited long-term payoff to market timing. Even if you were like the worst market timer ever or the best market timer ever, the difference in your results is actually surprisingly small. I did a study on this, which I'll put a link to right here. So if you're interested in that, click here and I'll see you in the next video. This video is sponsored by everyone who is currently supporting me on Patreon and YouTube Premium. In a few days, I'll be posting the October 2022 question and answer session. If you have a question for next month, I'll put a link to that here in a couple of weeks. I also updated my S&P 500 valuation model. I'll put a link in the description below for you premium subscribers if you're interested in seeing what the model suggests the fair value of the S&P was as of a couple of weeks ago.